So, if you're an American investor, maybe looking closely at Tesla, ticker TSLA, our job here is to really cut through all the noise.
Hmm.
We've gone through a ton of recent sources, analyst notes, financials, market talk, basically, to help you figure out the real risks and, well, the opportunities ahead.
Yeah, and it's crucial, I think, to frame this right from the start. When you look at TSLA, you're not evaluating a standard car company that goes up and down with the economy.
Right.
You're analyzing really a technology conglomerate,
Yeah.
and it's at a huge turning point, facing this massive kind of speculative bet on AI and energy. The volatility, it's extreme, but so is the potential upside.
Okay, let's unpack that volatility then, because the stock is absolutely
Sure thing.
buzzing right now, and it seems to be triggered by a really big, very public move from the top guy. What exactly lit the fuse this month?
Well, the catalyst was seen as a huge show of conviction. Regulatory filings came out showing CEO Elon Musk bought about, what was it, 2.57 million shares.
Okay.
This was mid-September 2025.
2.57 million shares sounds like a lot, but what's that in like dollar
We're
terms?
talking about $1 billion.
A billion. Wow. Okay, that's not pocket change. I mean, that's a serious chunk of change being put into one stock, basically in one go.
Exactly. And the really key thing here is this was his first direct share purchase since February 2020.
Right.
And it was the largest personal capital commitment he's ever made to Tesla, at least by dollar amount. It was definitely meant to send a signal.
And it looks like the market got that signal loud and clear. The
Yes, it did.
reaction was pretty much instant, right? Explosive.
Oh, yeah. The stock jumped, climbed
Yeah.
3.6% pretty quickly. It even touched $425.70 for a bit there,
Wow.
which was actually enough to pull the stock positive for the year for 2025.
So the street reaction was immediate. The bulls must have loved it.
Absolutely. Analysts who are bullish, especially the ones focused on Tesla's tech future, they saw this as Musk basically doubling down, putting his own money behind that long-term AI vision.
Hmm.
It showed a kind of confidence,
Yeah.
that goes way beyond just what's said on an earnings call.
And Musk, being Musk, he had to add his own spin, didn't he? Something on X about hitting $420.
He did. Yeah, he quipped on X, formerly Twitter, that the stock hit $420 as foretold in the prophecy. Classic Musk.
It definitely highlights that unique, almost mythical link between him and the stock price.
It really does. But, that personality-driven hype, it crashes right into a pretty serious issue. The valuation puzzle.
Ah.
The stock's already trading at levels that, frankly, scare a lot of traditional value-focused investors.
Okay, that's the part we really need to dig into. A PE of...
Like 201.
Is that right?
Around there, yeah. Some sources say 198, some 201. It fluctuates, but yeah, high.
That seems like it's pricing in years, maybe even a decade, of just flawless execution. What are the analysts saying, the ones who aren't completely sold on the hype?
Well, they look at that number, let's call it 200, while the average S&P 500 company sits around,
Yeah.
23?
Right, big difference.
Huge. And they argue the shares just look very expensive at current levels. They're basically saying, look, rationally, this valuation makes almost no sense if you're just looking at how many cars they're selling today.
So the argument has to be that the high PE isn't really about today's car sales. It's got to be about something else entirely.
Precisely. That's the core bull thesis. The market fundamentally misunderstands Tesla if it just sees an auto company.
Okay.
The high valuation isn't based on selling Model Ys right now. It's built on the expectation of, well, speculative exponential growth in two future areas with potentially massive margins: energy and physical AI.
Let's start with energy then, because our sources suggest this is kind of the quiet engine room, the profit driver that maybe gives them a financial cushion.
It's definitely showing surprising strength. The energy generation and storage segment that includes things like the Powerwall for homes, megapacks for utilities, it actually brought in nearly 20% of total revenue in Q3 2025.
20% pretty big.
Yeah, out of over $29 billion total revenue. It's substantial.
Okay, substantial revenue share, but what about the profitability? That's often the key. How much of that revenue is actually dropping to the bottom line?
And this is where it gets really interesting. That energy segment, it hit gross margins of over 30% in Q2 2025.
30%.
Yeah, which makes it, on a percentage basis, Tesla's most profitable division right now.
More profitable than cars, percentage-wise.
On a gross margin percentage basis, yes. And the growth is there too. Energy storage deployments jumped 48% year over year in Q2, hitting 9.6 gigawatt hours.
Gigawatt hours.
Oh,
That sounds like they're really scaling up capacity for big projects.
they are. It's a key indicator for building out that utility-scale storage business rapidly.
Okay, so the foundation is this high-margin energy storage business. But the real moonshot, the thing justifying that, sky-high PE, has to be the AI bet. That's where the big money's going, right?
That's the engine driving the whole vision, really. Tesla's pouring a planned $9 billion into capital expenditure just for 2025.
9 billion. And where's that going exactly?
It's targeted specifically for building out their Cortex AI training supercomputer cluster and producing, get this, 10,000 Optimus humanoid robots this year.
10,000 robots.
Yeah. So these huge bets, full self-driving, the whole Robotaxi network concept, and Optimus, these are what the bulls call the trillion-dollar opportunities. That's what they believe justifies the current price and the potential for much, much more growth.
That AI vision is definitely compelling. But okay, let's ground ourselves a bit. Let's talk about maybe the baggage that AI is currently attached to the core automotive business. What are the main worries there?
Yeah, you can see the strain in the numbers. Revenue in the main auto segment actually declined 2.73% for the 12 months ending Q2 2025.
Declined.
Yeah, but the real squeeze is on margins. Gross margins have really compressed, down to about 17.5% in Q2.
Ouch. Why the drop?
It's mostly driven by those strategic price cuts they've been doing. They need to keep demand up and defend their market share globally, especially with more competition.
And we're seeing that play out geographically too, right? Especially hearing rough news out of Europe.
We are. Germany, for example, which is a huge market for them in Europe, deliveries there fell dramatically. 41% year over year in 2024.
41%. Why such a big drop?
It seems to be a mix of things. Government EV incentives fading away, plus really fierce competition from the established European automakers and, increasingly, those aggressively priced Chinese brands.
And here in the U.S., market share isn't looking quite as dominant as it once was either.
No, it's showing some cracks. Tesla's U.S. EV market share dipped to 38% in August 2025. That's actually its lowest point since way back in 2017.
Still 38%, though. How does that stack up?
Well, context is important. Even at 38%, Tesla still sold more battery electric vehicles, BEVs, in the U.S. that month than the next four competitors combined.
Okay, so still the leader by a long shot.
In the U.S., yes, for BEVs. But globally, the picture is different. Tesla's got about 10.3% global share of just BEVs. Compare that to BYD at 22.2%.
Wow.
Now, granted, BYD's number includes plug-in hybrids, not just pure EV, so it's not a perfect comparison. But still, it shows the competition is really heating up worldwide. The market's maturing fast.
Okay, competition aside, are there other operational risks? Things analysts are flagging. I think I saw something about batteries.
Yes, that's a potentially serious headwind. It could make that margin pressure even worse. Some analysts are warning about a possible 15% increase in their cost of goods sold by the fourth quarter of 2025.
15%. Why?
Ongoing battery supply bottlenecks. Basically, if they can't get enough batteries or the cost goes up significantly, it really limits their ability to build cars and scale up that energy business. It hits both sides.
Look, we can't really talk about Tesla's risks without mentioning the elephant in the room. The key person risk.
Absolutely unavoidable. The stock price is just fundamentally linked to Elon Musk. His focus is split across demanding ventures like X, SpaceX, and his, let's say, controversial statements. They are constantly cited as a source of unnecessary stock volatility. If you invest in Tesla, you just have to accept that the CEO's personality is a built-in part of the risk profile.
Okay, let's pivot a bit. Let's look at the strengths, the advantages that maybe competitors can't easily copy. What's the durable competitive moat protecting Tesla?
I think it really comes down to their integrated ecosystem. First off, you've got the supercharger network.
Right.
Analysts consistently call this an insurmountable infrastructure lead. It's huge, it's reliable, and crucially, it's woven directly into the car's software for planning long trips. That user experience, nobody else has quite matched it yet.
Okay, infrastructure lead. What else? Manufacturing. I hear about gigacastings. What is that?
Yeah, this is a really big and maybe underappreciated advantage. Gigacastings means they use these enormous presses to create huge single pieces of the car's structure, like the whole front or rear underbody, instead of assembling hundreds of small parts.
So fewer parts, simpler assembly.
Exactly. Think of it like swapping a complex Lego kit for one giant pre-molded block. It massively simplifies the factory, cuts weight, saves cost. It gives them an industry-leading edge in manufacturing cost and efficiency.
Interesting. But the real long-term, the one that maybe justifies that massive $9 billion AI spend is the data, right? The software platform.
That's the flywheel.
Yeah.
And it's, frankly, unrivaled right now. Tesla isn't just a car company, it's a software behemoth on wheels.
Okay.
You get over-the-air updates that make the car better over time. But even more importantly, those millions of Teslas already driving around, they act like a giant distributed network of sensors,
Constantly collecting data.
constantly collecting massive amounts of high-quality, real-world driving data. And
Huh.
that data is absolutely invaluable for training the AI needed for both full self-driving, the Robotaxi idea, and also for the Optimus robot. No other competitor has that sheer volume and variety of real-world data to feed their systems.
And they have the money to actually fund all these huge ambitions internally.
They do.
Mm-hmm.
Their balance sheet is incredibly strong. They're sitting on something like $37 billion in cash and investments.
Wow.
And they generated $3.6 billion in free cash flow back in 2024. That financial muscle, that war chest, gives them the cushion to pay for the huge gigafactory expansions and those multi-billion-dollar AI bets without having to constantly raise more money.
Okay, so bringing it all together, the volatility, the risks, the huge potential upside, what's the practical approach for an investor looking at TSLA today?
Well, the consensus among proponents seems clear. This isn't a stock you trade based on quarterly delivery numbers. Forget that.
Okay.
You're making a long-term bet on a whole portfolio of potentially disruptive technologies.
Yeah.
The wild swings are just part of the deal, so managing that risk is absolutely key.
And what are the main strategies the sources suggest for, navigating this?
Two main things come up. First, investors probably need to adjust how they value the company. Prioritize the growing, high-margin energy business, maybe more than the cyclical, price-sensitive automotive side. That's where the stability might come from.
Okay, focus on energy. What's the second?
Second, keep a very close eye on that $9 billion AI spending. Specifically, track the ratio of capital expenditure to free cash flow.
Why that ratio?
If that ratio starts creeping above, say, 1.5, it could be a warning sign. It might mean they're overextending themselves, burning through that crucial cash fortress too quickly.
Got it. Monitor the spending discipline. The high stakes here are really reflected in the analyst price targets, right? They seem to be all over the map.
Oh, completely. The range is just extraordinary. On the bullish side, you've got firms like Baird targeting $548 a share, really emphasizing that physical AI potential.
Hmm.
Then you get into the really speculative territory like ARK Invest's model. They've talked about scenarios leading to maybe $3,000 per share, but that hinges entirely on them cracking full robotaxi autonomy, which is still a huge if.
$3,000. That's basically betting on them completely changing transportation as we know it. What about the more cautious views?
On the bearish end, you see more traditional valuations. Guggenheim, for instance, has a sell rating with a price target down at $175.
Big spread.
It really shows the fundamental divide in the investment community. Are you valuing the company based on what it makes today, or are you valuing its potential to become a dominant technology platform tomorrow?
So circling back to where we started, for the investor considering TSLA, that big Musk purchase seems to reinforce the long-term story.
Correct. I think the core investment thesis, for those who buy in, is that the current stock price, even with its volatility, represents a potentially compelling entry point if you're a growth-oriented investor. You're betting that the combined power of energy, autonomy, and robotics will eventually dwarf the traditional car business.
So what does this all boil down to for you, the listener, the potential investor? You're not just buying shares in a car maker. You're investing in a company that increasingly sees its cars as, well, data collecting assets for a much bigger, much riskier, but potentially world-changing business model that goes way beyond just building vehicles.
Yes, exactly. Tesla is actively trying to transform its own risk profile right now. It's trading some near-term profitability in the auto sector for potentially exponential gains down the road in AI and energy infrastructure. You're watching this transformation happen in real time.
And just to leave you with one final thought, something that really underscores the sheer scale of this bet. Elon Musk himself has suggested, maybe just throwing it out there, maybe seriously, that the Optimus humanoid robot alone could eventually make up something like 80% of Tesla's long-term value, and that it could push the company's total market cap towards an almost unimaginable $25 trillion. That's the kind of magnitude, the kind of future you're weighing up when you consider investing in Tesla today.